Fed Chair Jay Powell telling investors that inflation is starting to ease. That's the good news. The bad news is, though, interest rates are still likely to rise. Steve Leisman joins us with more right now. And, Steve, there was a little bit of something for everybody in those comments that he made yesterday.
Exactly, Becky. And I think the markets gave the Fed chair a split decision. These were his first comments on that very strong January jobs report. And he suggested if such strength continues, the Fed may have to raise rates higher than it had previously forecast.
The reality is we're going to react to the data. So if we continue to get, for example, strong labor market reports or higher inflation reports, it may well be the case that we have to do more and raise hikes more than is priced in.
So markets gave Powell, like I said, a split decision. Stocks rallied after the speech, with some saying Powell was not as hawkish as he could have been, and that he continued to say inflation is easing, even if bringing it down is going to be a bumpy road. But the Fed funds futures market, it increased its outlook for the peak funds rate. The peak funds rate had been 4.89 for the June contract before the jobs number. The peak contract is now August, and it's trading with a yield of 5.14, exactly where the Fed is for year end. Rubila Faruqi from HFE writing after the speech, at a minimum, we expect another 2 hikes, with the caveat that rates could move higher than currently expected. We do not anticipate an easing of monetary policy this year. As we've reported this week, the gap between where the market thinks the Fed is going and where the Fed says it's going, it's narrowed dramatically since that jobs number. An argument that had been about 3/4 of a percentage point, pretty substantial, is now just about 1/3 of a percentage point. And they've got a whole year to work it out, with the important question of whether the stock market now believes what the bond market is saying, Becky.